Welcome to Enlightened Wealth Strategies, the podcast where insight and knowledge meet opportunity. Please join us as we navigate the world of finance, discovering actionable strategies to help you achieve your personal financial goals.
With decades of combined experience, we're here to shed light on the topics that matter most to your financial well-being. Whether you're accumulating, preserving, or distributing your wealth, this is the place for you.
Now let's dive in and start your journey to financial enlightenment.
Hello, James. Welcome to another episode of Enlightened Wealth Strategies.
Why are you here? Welcome, Jim. Good morning. Or is it afternoon?
It's
afternoon.
It's afternoon.
Well,
Soon to be.
good to see you again.
Same here.
And we have another podcast.
We do.
And we have an in-studio guest.
We do.
How exciting.
Very.
Well, it is. It's nice to interview people on a virtual basis, but I think it's always better when we can interview them in person so that they are sitting across from us.
We see their reactions
to your silly questions.
to my silly questions.
And my dopey questions. So I just want to remind our audience to make sure that they like and subscribe to our podcast. So with that, no further ado, let's introduce our guest, Aaron Galileo, and you're going to tell us all about mortgages today.
I am. Hello, Jim and James. Thank you for inviting me.
It's James and Jim.
Pleasure to be here.
Just
James,
get it right.
James and Jim.
Jim.
Not Jim and James.
James. Okay.
James, the good-looking one. I'm the taller one.
Got it. Understood. Yes. Mortgages or residential lending, if we want to be fancy.
Now, who are you with?
So I work for PPAC Private Bank and Trust, which is a bank headquartered in Bedminster, New Jersey since 1921. And we are a market leader here in the New York metro area, offering a boutique experience for our clients. It's relationship-driven, client-centric, single point of contact banking solutions.
Now, have you been in the industry for a while?
I have. This will be my 20th year coming up.
So you have experience.
I'm
Our listeners
seasoned.
will love that.
Oh, thank you.
Yeah, seasoned is a good word.
Seasoned.
Veteran is a nice word,
Yes.
too.
Old is fine.
We don't want to use old.
Definitely not old. Young at heart.
Yes.
So, now, how long have you been with the organization?
I just joined PPAC last year. I've been working for small banks for most of my career. 90% of it I've been with smaller type banks.
Right, and the regional based,
banks,
right?
yes.
Yeah. And you and I, before we started, we were commenting about how long we have known each other, and it's probably in excess of 15 years or so.
Yes. We think 2009-ish.
Yes.
All right. So it's been
and we commiserate quite a bit about our local team, the New York Giants. So we're going to dedicate about 15 minutes to talk about them.
No.
It's a good thing Jim's here to stop us from that.
No, we don't want to do that.
No.
And as a season ticket holder, it must be really tough going into these
Yes.
games and sitting in the freeze. Did you go recently in freezing cold and sit there and watch them?
Yes.
You don't have to create pain for the man.
But I've been a Giants fan since 1968, so I'm really dating myself.
And I look to you for guidance and support, and I think that you seem to be failing at that now too. It's wearing you down. I think.
What's that?
The Giants. You used to be more upbeat.
Yeah, I'm not as emotionally connected anymore.
No, you're not.
I have other things in life that take my time. I watch
Guys,
them, but not as much.
Now we're getting really off topic.
But this is important, though, because there's a lot of Giants fans out there that may want to buy a house.
What about the Eagle fans from my neck of the woods?
Things go in trends. The trend will reverse. In many years, it was the Eagles, then it was the Giants. Now it's the Eagles again, but it'll be the Giants again. That's
Of
how
course.
things work.
Yes.
We hope
So.
at least.
Anyway,
Just
let's
hang in
get
there.
back to the housing industry.
Yes.
So, in general, let's start more locally. What are the trends in the housing market in this region, the tri-state region?
Sure.
Maybe we start there. New York, New Jersey, Connecticut, perhaps. I don't know where else you do lending for your clients.
All over, but New York and New Jersey primarily. Certainly Connecticut, Delaware, Pennsylvania, the contiguous states. So I'm glad you said locally, because you see headlines that say housing prices are dropping, housing prices are rising. There's not enough inventory. So it really depends on where you are. So here, inventory is still tight in the towns in New Jersey, and even in parts of Manhattan, there's not enough inventory, and there are a lot of buyers. So there's still some pain out there, particularly in certain price ranges. A lot of the starter homes, there's 10, 20, 30 people bidding on a house that's priced right. So it's
what
a
is a starter home priced at today?
Well, that's a fair question. I mean, it may be.
And that also depends upon county to county too, because certain areas are less expensive. I mean, This is a very expensive area of the country.
It is, and there are towns here that have really good schools and that have trains, and they're always desirable. Mm-hmm. So those towns have continued to go up, and it has slowed down. The price increase, thankfully, has slowed down, but inventory is still the biggest problem. And that's, of course, a factor of other things like the interest rates, where people have a 3 or 4% mortgage. They may not necessarily want to sell their house and buy another house with a higher rate. So that is keeping some houses from coming on the market.
Yeah, so in other words, if they're in that 2, 3, 4% mortgage, they're not necessarily going to go out and sell that home to buy another home to be at 6 and 7% or more.
Right.
Depending upon where they are in life.
Yes. And there are people that have to sell. They're because of a divorce or a death in the family, or you're transferred. So there are people that have to sell.
Or their family's getting bigger.
Right.
Yeah.
You outgrow, but I think people are staying in their houses a little bit longer. The move-up buyers are staying in their houses a little bit longer because of the environment, because it may be a great time to sell your house because the prices are high, but then you have the challenge of finding a house.
We just had an interview earlier, and we were talking about the housing market in general and the companies that build homes. And I'm sure you're well aware that in this country we have a housing shortage, and that's probably a byproduct of the growth of the country, but also the immigrant crisis that we've experienced as well. Now, maybe that's changing a little bit because of the policies of the Trump administration, but I don't see that everyone just packed up and left. We're still moving forward. We're still going to have this housing. I don't know if we call it a crisis, but it's close.
It's a challenge.
Yeah.
Certainly. And there's so many, real estate is such a far-reaching part of our economy, where it's things like now things are a little bit more expensive maybe to build a house, so that builders are changing their strategies. Just things like zoning can be a challenge, where maybe if the zoning laws were changed a little bit, we'd be able to build a little more in certain areas. I mean, New Jersey is a very dense state. There's not, especially North Jersey, there's not a ton of room to build, but it's not easy to build a house.
Well, what I see in a lot of the towns, I'm in northern Bergen County, what I see in a lot of these towns is they're shoehorning into smaller lots.
Yeah. It's all skinny houses.
Skinny houses or multi-housing. Mm-hmm. If they get a big enough plot, they'll make a horseshoe where they're putting townhomes in or condos, multi-layered.
Yes.
And this way they get more people. They get higher tax rate, of course. Anyway, so what do you see going forward, number one? And number two, how does this impact the younger generations and their ability to buy homes? You know, I always I commented about being a Giants fan from 1968. My parents bought a home in 1967 for a whopping $21,000. You can't get very much for $21,000 today. And of course, people think the house is increased in value, but
it's probably just the taxes.
No, that's probably just the taxes, exactly.
Yes.
But it's inflation based predominantly. That a house that used to be $21,000 is now probably worth $500,000 or $600,000 or $700,000, depending upon where it is.
Yes. So it's not easy. My daughter is 28, and she looks at the housing prices around us and said, "How am I going to afford this house?" And I don't remember feeling that way when I was her age. So it is a little different. Housing prices have gone up so much that people are renting longer. And now I read that the average age, and I guess this is on a nationwide basis, of a first-time homebuyer is now 30.
30.
So that's
30, 31, yes.
right. That's shocking. I mean, think of where a lot of us were when we were 30, whether it's kids or houses or on your second house or third house or wherever you are in life. It's different. They're renting, and I don't know that they view it as a negative thing. I mean, renting is easier, right? Maybe they're more focused on their career or themselves or whatever, rather than taking care of a house. So I don't hear a tremendous amount of complaining from people that I talk to, younger generation. They're just waiting. They're waiting until they save a little more.
I think they're a little bit more accepting of the fact, as because of what you described her thoughts, is that it's just too expensive. Where am I coming up with the down payment, and let alone having to meet this monthly mortgage? Because down payment, if you're going to buy a home, just even if it's $500,000, what would you advise people to do there? You would prefer that they put 20% down, but realistically, that's a lot of savings. That's a lot of years of working to put aside $100,000 just for a home, and then you still have a $400,000 mortgage, and that may not be the house you necessarily want. You may want to improve the kitchen and the bathroom, which are the most common areas that people improve on.
Yes.
And now you're talking, unless you're a do-it-yourselfer, you're talking about another 20, 30, 40, 50,000 that you're going to do in home improvements.
Yes. And there are people that have that money and don't want to spend it on a house because it's not the house that they want.
Right.
So that's another.
And now it's
factor.
Are they looking to leap to the next house in 2 to 3 years?
Right. And they're waiting. That's why they're 30 when they're buying their first house. And I think that homeownership is still a path to wealth and a path to financial stability, but not everyone agrees. But and you two certainly know there are other ways. There are other things to do with your money. Right?
I've actually been finding a lot of the younger generations trying to save more in the beginning, and they'll still be home with their parents to accumulate some wealth, knowing that to buy a home, they're going to need a sizable down payment.
Yeah, well, then that makes sense. And then the other piece of it is the other flip side to it is, as you mentioned, is rent. They're maybe renting, but rent is continuing to go up.
It is.
And it's not like incremental. It's dramatic, the increases.
It's interesting times. Maybe not right this second, but over the past couple of years, rates have been going up, rents have been going up, and home prices have been going up. So that's a lot of times rates go up, prices go down. So we didn't necessarily see that correlation. So it's interesting times.
Is it just a byproduct of supply and demand?
I think so. I think that
basic economics.
Yes, but unusual, right? I mean, I think that I have not seen rates and prices go up the way that they
in your 25 plus years of doing
20 years. I have not, and we've been through, good and bad. 2008 was terrible. The second half was as bad as I've seen in my life for the economy, and certainly the mortgage and housing market post-pandemic has not been good. Where the pandemic was, rates were the rates that we had never seen before, so it was a little bit of a boom. But these are interesting times and not easy to navigate. To your point about the younger generation trying to figure it out.
Yeah, and the reason why I ask with regard to the younger generation is because historically, housing ownership of home ownership in the United States has hovered around 2/3, 60, 65%. Where does it stand today? It's less, correct?
It is. I think it's probably closer. It is still between 50 and 60%. I believe. I'm trying to think of the numbers that I saw, and I'm thinking of people without mortgages. I know has gone up, but I think it's still around between 50 and
60%. Yeah, I think it's closer to 60. But going back to the Clinton years, they were looking to get it beyond 65 and closer to 70%. And then, of course, when we had 2008
Yeah,
crisis.
that changed things.
That changed things, but that was maybe the highest, but you had people that were owning homes with no docs, and that doesn't exist anymore. So just maybe taking that for the next step. What's the process that people go through just to put an application in to get a mortgage in light of all those changes? I know that was many years ago, but there have also been changes in recent years as well with regard to the mortgage industry. Is that correct?
It is, and most of it in response to what we've spoken about is 2008. Things have gotten tighter for good reason, right? That you can't just get a mortgage now without
because you breathe,
right? Without proving that you can afford it. There's a piece of legislation that's part of a larger bill called Ability to Repay, ATR. You have to show that you can actually afford the mortgage that you're getting with your income and with your assets. So the process hasn't changed that much. It's talking to a bank, to a lender about your financial situation and how much you can afford, and it's having frank conversations. I may tell you can afford X, but do you really want to pay X? Is that going to affect your ability to go away and to eat out 3 times a week and to buy the purse, whatever it is, the car? So we have the same kind of conversations you have with your clients about where they want to be and how are we going to get there? Is buying this big house the best thing, or maybe we should talk about a little bit of a smaller mortgage or down payment. So it's conversations, and they're in-depth conversations about their income and their assets, and we look at their credit, and then they go out and look. And it used to be the hardest part was I thought it was hard to get a before the no doc loans. It was a little bit harder to get a mortgage, a little bit stricter. It was 20% down before mortgage insurance and everything. Now the hardest part is finding a house and getting an accepted offer. That's the easier part is the pre-approval and the mortgage and the financing process.
But that's not easy either, though. It's just that getting the house is now more difficult than everything else.
None of it is. You're absolutely right. None of it is easy. Even if you're a super strong financial profile, it's still a little bit arduous. I'm asking for your tax returns and your pay stubs and your driver's license, and there's a little bit of work, and you get a disclosure package that you have to review and e-sign, and so there are things that you have to do. There's effort in getting the financing, but the biggest effort now is finding a house and looking at. You may look at, and when I say house, it could be a condo or it could be a co-op. Whatever it is, but you may look at a lot of them and make a lot of offers before you have an accepted offer.
Right. Jim, any thoughts?
Well, I was actually just thinking a lot with regards to my 2 boys. They're renting now, and they were talking to me about purchasing a place, and they opted not to because they want to accumulate more assets. And it's just fascinating, the mindset of everybody, because they find it easier to travel and do things when they're renting as opposed to taking care of a home.
They don't have the responsibility, right?
Exactly.
Yeah.
So that, I think, comes into play as to why everybody's taking so much longer before they purchase their first home.
It is a real mindset shift.
Yes.
It is, because that's not the way I felt. I wanted to buy a house as soon as
you got a job, almost
as I could afford it.
Mm-hmm.
But I wasn't as mobile as this generation. They do travel a lot, and they do move around for jobs, I think, more than I'm Generation X than we did. So it's a different. I agree.
Different mindset, different game.
It is, and it also depends on how you grew up. I mean, if the kids see their parents bought a house and it was a positive thing in their life, then they want to buy a house. If their parents rented or the house was always a problem, they were always fixing things, then you have a little bit of a different attitude about homeownership.
Yeah, and I think also too, it's people that are probably more so in the housing market are those that have already started a family or want to start a family. And those are the ones that probably are just on the cusp of getting a higher income, or they're both working And then they also have to deal with childcare if they already do have children. So it is problematic because, as we talked about in the previous interview, is nothing is getting less expensive. Inflation went up. Yeah, it's going down, but inflation doesn't necessarily go away.
Right. No,
it continues
to climb.
And that makes it harder, too, because, as you described, you're interviewing them and what they can afford, but also what are they willing to sacrifice.
Yes.
And if you want something in life, I always say you got to be disciplined and you got to sacrifice to get it.
At least compromise, right? There is give and take. And you, I like to involve as much as possible a team of financial planners, the real estate broker, trust and estates, whoever's involved, to make sure we're all going the same direction, because you may think for your client the best thing is it would be better if they put away $1,000 a month, whatever the number is for their long-term financial planning, rather than spending that on a house. So there's always what's the best thing for the client, right? And if you have a collaborative effort, it's easier to come to that, because a lot of people don't know. They know maybe where they want to be, but they don't know how to get there. And there's lots of different paths.
And the other thing too is, unlike what you and I and even Jim we dealt with, is that the information we had wasn't on the internet, wasn't on the computer. Yes, there's more information, but I actually think it's more confusing in some ways, because now they have to not only do the research, but then understand it. And then sometimes they want to do it on their own.
Yes.
And there's gaps, and they're not quite understanding how that all fits in with themselves. So you are absolutely right. When they come to you, there should be a collaboration if they have other advisors in their life. And if they don't, maybe this is a good time in which to engage with them.
Yes.
So taking this discussion to the next topic, I would like, and I'm sure our audience would like this, and perhaps you would agree as well, Jim, is where are rates right now?
So here's this is
words right out of my mouth.
Always a frustrating. So I get people that call me often, and maybe someone referred me, maybe the person sitting next to them at work used me in the past, and they say, I'm buying a house. Okay, call Aaron. He's got good rates and does a great job. So they call and they say, what is your rate today? And that is, I have a litany of questions that I have to ask you to try to get to the right rate. And that is very frustrating for people. That, along with, and not to go down this path, but okay, the Fed lowered rates. Why did mortgage rates go up? Those are two things that frustrate people tremendously. So
they just want an answer. Just give me a number.
And I could give you a number,
but that's not realistic.
It's all based on how much they're borrowing, what their credit scores are.
Right.
It just
there's a lot of factors.
Are you buying I could give you a rate, but then you tell me you're buying a 4-family investment property and your credit score is 620. So now the rate that I gave you is in a different galaxy.
Right.
So
different galaxy.
I have to ask you a lot of questions. And people say, can you just give me a rate? They have a list of people they want to call and get rates. And so that frustrates people. So you mentioned a lot of the things that go into a credit score. How much are you putting down? Where are you buying? And what are you buying? And what's the purpose of buying? Are you buying it to live in? Because those rates are going to be better than if you're buying it as an investment property.
Or if they're buying a 2-family house.
Right. Typically a 2, 3, 4 family, and a 5-unit becomes commercial. So 1 to 4 family is residential. A 4-unit house, even if you live in it, is going to be, the rate is typically going to be higher than if it's a single family house. Sometimes a condo, the rate can be a little bit higher if you're not putting 25% down. So there's lots of little nuances. If you're doing a refinance and you're taking money out of your house, the rate's a little bit higher. So it's hard to give a rate. And when I give a rate, it triggers a truth in lending. So if I give a rate in writing, I have to put I have to give the APR, I have to give a whole bunch of disclosures. So it's
well, what's the national average rate for a 30-year mortgage?
It's in the 6s now. The low 6s, I think, is where it is now. But I've seen lower, I've seen higher, and there are things that go into it, like maybe they're paying a point. So a point is is 1% of the loan amount. So if it's a $100,000 loan, it's $1,000. So that's a fee to lower the rate. So that's another thing you always have to check. Okay, that rate looks really good. Oh, but they're charging 1.5 points, or
I mean, that means they got to come up with the cash, or they're going to finance it.
And sometimes it may make sense, right? It depends on the person's situation. So, be prepared to get a bunch of questions when you ask someone, "What's today's rate?" And you'll see there are ads on TV or on the radio or on the internet with a rate, and you have to dig in a little bit to see what they're basing that rate on. Are they basing it on a person with 780 credit score that's putting down 30% and buying a single family owner occupied home? May be different than your.
It's not cut and dry.
Than your situation.
It's not a cut and dry response. It can't be.
And I wish it was, because that is a frustrating thing for people who are just shopping around for rates. And that's not really the space that I've been in my career is the lowest rate. That's more of a relationship like you type thing, where it's a more comprehensive experience and I like to hope a smoother experience than you may get from the person, the bank that has the lowest rate.
And the relationship is, you hope that by creating this and going through this process, that they're going to come back to you again, either for a new purchase, a refinance, family, whomever, that it's a continuing, ongoing relationship.
Those are the best. When someone calls me and says, I just have a client, I did her father's loan at the shore. He bought a beach house, and now I'm helping his daughter. She's an example. She just made an offer last weekend. So I emailed her on Monday, said, "How did your offer go?" So I'm not sure yet. She emailed me by the end of the day. We were the lowest offer. So they're moving on to the next thing. They make not every week, but often they're making offers, and there's 8 or 9 other people or more that are making offers, and they are, you'd like them. They know how much they want to spend, and they've talked to their financial planner, and this is where they are. So if they have to keep making offers, they will. And if they have to keep renting, they will until they're comfortable.
And so they don't get emotionally attached. That's the other thing that's really important. You have to go in this like it's a battle, and accept the fact that, well, it wasn't meant to be. My offer wasn't accepted, or our offer wasn't accepted, and we go on to the next one.
And that's then causing the housing market to go up, because you get multiple offers, and whoever has the highest bid, it's sometimes, or a lot of times, over the asking price.
Yes.
And if it's over the asking price, that impacts the mortgage as well, because of whether you're only going to give based on the value of the house. You're not going to, even though they're giving much more. So that's got to come out of their pockets too.
It does. And what you're alluding to happened during the pandemic with appraisals, when the housing prices were rising so fast that there weren't comparable sales to support it. Mm-hmm. So it was a little bit, not a lot, but a little bit of a problem with the houses appraising for the price that the person bought it for, because it was maybe $100,000, $200,000 over the ask, and the houses in the neighborhood that have sold recently were not that high, so there weren't appraisals to support it. So thankfully they've caught up, but yes, that is certainly an affordability issue. And
okay, I got a couple of questions for you. So as a CPA, I'm going to ask tax questions.
Sure.
So is there not a cap now on mortgages at $750,000? That's up to that point is deductible. The interest.
There
in
is
years past, it was $1 million.
Is $750?
Is that
was that in the big beautiful bill? Yes. Okay. So
well, it was prior to that, but I think now it's permanent.
Right.
So I have been in meetings with CPAs and financial planners and clients where they have said, buy this house because you want to buy this. This is where you want to live and raise a family or whatever you want to do. And view the tax benefits as gravy because
secondary.
Because it changes.
Yes.
So
as I always say, you should never let the tax tail wag the investment dog. Well, it applies for the same thing. You don't want taxes to be wagging the decision of you buying a home which you're going to live in and raise a family in. Or even if somebody's at a different stage in life, that shouldn't be but it is important information for people to be aware of.
It is when you're looking at the totality of the payment, maybe it's a little bit of a stretch for us, but we're going to get some tax relief, so it's not as much of a stretch.
But the other component to that too is, are people really getting relief? Because under the Tax Cuts and Jobs Act back in 2017, they moved the standard deduction up based on your filing status to such a higher level, and that a lot of people were not getting the benefit of itemized deduction. So even if you were prior to that able to deduct your mortgage, now you may not, because the mortgage interest doesn't, that combined with the other itemized deductions, not exceed the standard deduction. And now this is permanent based on the OBA, the big beautiful bill.
Yes. Again, it's okay. It's time to buy a house. Here's a house we like.
I mean, it is nice to know that if you're getting a 6.25% mortgage, and if you're in a 30% tax bracket, even 25%, that you're getting, a benefit for that, and your mortgage is closer to 5% or so. But hey, you're not. That shouldn't be the decision-making factor.
Right. And it goes to timing, right? I'm sure you tell people you can't time the stock market, and I tell people you can't. It's almost impossible to perfectly time something like a housing market or a stock market. So it goes to the financial readiness. Are we ready to buy a house? Okay, let's buy a house. We need to. We have a growing family, or we just got married, or we just got to whatever the reason. So that the financial readiness of someone, I think, is more important than trying to time the market, trying to time something that
right. That's a losing game if you're going to do that. So going back to the rates, one area that we mentioned rates in general, but we didn't mention the impact of the Federal Reserve and what it does, because a lot of people have this misconception or misunderstanding that if rates come down, that should mean mortgage rates come down. Yes. But that's not necessarily the case. Maybe you could explain why to our audience.
It's not, and this isn't something that frustrates people. And I have people who call me, and it's in the news, right? The Fed rates are in the news
all the time,
a lot. So if you don't, and you just hear a little soundbite. Oh, I heard that rates are going down soon. I don't want to lock in now because I heard rates are coming down. Mm-hmm. So the easiest way that, and it's been explained to me this way, and I like this explanation, is we're dealing typically with 30-year mortgages, very, very long-term debt. The Federal Reserve controls very short-term debt, the federal funds rate, which is the simplest terms. It's banks lending to other banks overnight,
exactly,
and how much they charge each other. So they control the federal funds rate, right? And they can lower it to try to stimulate the economy, and they can raise it to try to stave off inflation and slow things down. So when they lower the federal funds rate, it doesn't certainly does not directly affect a 30-year mortgage, right? It's the bond market that is affecting mortgage rates. And
so which bond market? So because that's the other piece of this.
And I tell, really, it's mortgage-backed securities, which are pools of mortgages that are sold, and they act like bonds, right? A mortgage-backed security is effectively a bond, but it's the 10-year Treasury is that's what I look at all day long, and a lot of people know that now, because for the reason you said, that they ask AI what affects the interest rate, what should I be watching? So they'll call me and they say, well, I see the 10-year is down. Did the rates go down? And again, it's not direct correlation between the two. And right now there has been more of a gap between the 10-year and mortgage rates than there is historically. But that's what we watch. That is an indicator of where the rates are going. And there are people, Bill Bodner is a rate guru that I watch. He has a correlation between oil and mortgages, not on the real short term, but if you look at a chart of, I don't know what probably 6 months, a year, 10 years, and there's a when oil's high, the rates are high. When oil's low,
Is that so?
the rates
So
are
he's
low.
found a correlation.
So
And
again,
now oil is coming down.
right. So the rates are kind of sideways, a little bit lower. That's the trend. But right after the Fed, right after they lowered rates, the rates went up because of the comments more than anything else that the bond market seemed to think this is maybe the end of the cycle, of the loosening cycle, and maybe there's going to be no cuts next year or one cut, but not a lot. So,
Yeah, but it's really interesting too. If you go back a couple of months ago, they had the cut in September, and as far back as October, the probability of a rate cut was like 50-50. Then all of a sudden it went to 60-40. Then it was 85% a week or two before. And voila. So we don't know what we don't know going forward, what's going to happen.
No.
I mean, I just find that fascinating that this gentleman finds a correlation with oil prices, and now what, $55 a barrel it's down to? Yeah, that's West Texas crude, I believe, right?
well, I know that this Venezuela, I think may go up a little bit. That's what I was reading this morning. That maybe this our interest in Venezuela may cause the oil prices to rise a little bit.
I think that whole situation is much more complicated, and I don't think the administration is necessarily going to send troops into Venezuela, as some people are suggesting. I don't think that's happening.
But that's, oil gets spooked. Oil market
It gets
certainly
spooked
gets
nonetheless,
spooked,
of course.
right? And the bond market is still wary of inflation, and it doesn't like the government debt, the large government debt. So that's always hanging in the back. If I don't have a direct answer for why the bond market is going up when it seemingly should be going down, I think they're afraid of looming in inflation, or based on a lot of the government debt.
Yeah, and the government debt is out of control. Although, are they making inroads with the tariff income? Perhaps. I mean, that's what they're suggesting. But nonetheless, moving forward with regard to this, how does those rates, will they continue to, what's the anticipation? Yeah, into the new year.
Yeah, so waffle is the word. So I've heard that they're going to, if you look, I saw a chart of, all the big real estate companies and the boards of realtors and the National Association of Realtors and their predictions, and it's pretty flat. By the end of the year, I think they think it's going to be a little bit lower than now. But I have heard more than one person say it's the only way there'll be a big swing down in rates is if there's a bad recession. Now, I don't know if that's true, but that's a lot of the sentiment is that there's not going to be a huge dip in rates without some real negative economic news.
So they're going to be in that 6% range for the foreseeable future, is what, based upon
yes.
what? Yeah.
For if you I feel like you can get virtually any point of view on the internet, right? Any point of view that you have, you can find support for it.
Right.
Which is, to your point before about people getting confused. But I think if you go mainstream experts, that they think it's going to be a little bit lower, but not dramatically so.
Well, let's shift gears. So when you're doing the documentation and you're going through everything, and they have decided that they want to buy a house, how do they get a mortgage? Where are they getting the mortgage from? Because is it the various federal agencies, the Fannie Mae's and Federal Home AF, yeah. And how does that work? And what's and the other thing is, what percentage of mortgages are coming from these government agencies versus financial institutions? And then thereafter, who is administering the mortgage?
Okay, so that's a great question and another complex question. So Fannie Mae and to a lesser extent Freddie Mac, they own most of the mortgages in this country, right? Chances are that if you get a mortgage, it's going to be sold to Fannie Mae. It may
And
be
who's Fannie Mae and who's Freddie Mac? I know those are the fancy
yes
nicknames that we gave.
Acronyms.
GSE,
Yes.
these government-sponsored enterprises that in 2008 the government guaranteed, right? They essentially took over and it's been a seemingly good investment, right? They've been turning they got
profits.
They got profitable. So
right.
they were set up to keep the mortgage market liquid, to make it easier to buy a house. There are banks like PPAC Private Bank and Trust where we are lending our own money often, where it's a loan that we keep in our portfolio. So we lend you our money.
You keep yours in the portfolio.
We can sell them too, but
Right.
like a much larger bank is probably selling more to Fannie Mae because it keeps them liquid, right? They're lending their own money and then they sell the loan to Fannie. Fannie pays them, and now Fannie Mae owns it. And now you asked who services it. There are companies that's what they do.
All they do, right?
They collect your payment, they collect your taxes, they pay your taxes. They're the ones who are sending you your bill, and so it's still Fannie Mae is still the dominant player, and they're very sensitive to. We were talking about things that go into the rate. Fannie's very sensitive to credit score and 2-family versus one family. So the rates can go up or down. Mostly up really fast.
So to that point, though, I don't mean to interrupt. You said they're profitable. So this is confusing for people. If they're profitable, are they a private entity or a government entity, or are they quasi-government agency?
It's quasi because the government involvement really was a guarantee, right? Because they were going to fail in 2008, right? They were not going to be able to satisfy their obligations. So the government stepped in and said, we'll guarantee it. And I don't know how much money the federal government pumped into them, but it was billions and billions. So Fannie Mae had to pay that back. And now the loans they give are much stricter. They don't have loose guidelines. So they have good payment history, right? They're lending to people who
are paying back, right?
Yes.
They're not as risky.
Right.
So do you know what a percentage of defaults?
For Fannie, I don't. It's probably
very low, right?
Yes. Yeah. Because it's okay. You make X amount of money. Let me see your pay stubs. Let me see your W-2s. Let me see your tax returns. So it's there's not a lot of gray with
there's not a lot of wiggle room anymore.
Right. With the self-employed buyer, sometimes there is we're looking at their tax returns where it's not they're not getting a paycheck every week and getting it. They're getting a 1099. So there may be some things there that can receive different treatment. But
and now you're looking at their gross income or their net income, a self-employed individual.
Ultimately, we're looking at their net income. But there are things that we may be able to add, like a depreciation.
Mm-hmm.
There are things that can be added back in or taken back out if they have certain expenses. So there's an analysis that happens, and more a computer can do it. Right?
Well, self-employed is trickier. That's why I asked that question.
It is that if you're self-employed, I suggest you talk to a lender earlier on than if you're a policeman or a school teacher or
it's a good W-2.
Right. There's no gray area. You make this is how much money you make. If you're commission or you're 1099 or you have your income varies widely because of bonus, then talk to someone early on so you can get a handle on what you can afford. It's not as easy.
What about down payments?
So you said it before, 20% is ideal, but that's not always realistic in this market. So there you can still put down 3%, 5%, 10% with different programs. If you put down less than 20%, you have to pay what is called PMI, mortgage insurance, which is one of the things that has gone down. PMI is cheaper now than it was a few years ago. I think also probably part of that is that they had to tighten up their guidelines, so they don't have a lot of payouts that they're making. So PMI is not an arduous thing, and I tell people when you're ready to buy a house, I'm going to tell you how much you can afford and how much your payments are going to be, including PMI, and if that works, then then let's buy a house.
And here's one thing that people overlook. They need to reevaluate their house after 3 or 5 years because they get the home reassessed, right? I shouldn't say reassessed, but revalued. That perhaps they have exceeded the 20% and can get the PMI removed.
Yes, and usually the person has to take the affirmative. If we're in a market where the housing prices have really gone up, then that becomes a reality. And you call your lender and you say, I think, or whoever's a servicer, really, it's whoever's servicing the loan at that point, and say, I think my house is now worth enough that the PMI can come off. Probably the consumer has to pay for the appraisal. The lender will order it. And yes, you can have it.
Yeah, come to your house and they look at it and they can just come back with a report. And if it's greater, then the PMI disappears.
Yes. So PMI is not it's a positive thing. It allows you to, it was created to allow people
to put less down
because banks didn't want to lend less than 20%. So the other thing with 20% down or more is when you're making an offer, the seller likes to see a bigger down payment, right? The seller would like to see cash. That would be the best thing. But if you and I are making the same offer or close to the same offer and you're putting down 20% and I'm putting down 5%, they're more inclined to take your offer because you are seemingly a stronger borrower and may have less trouble getting a mortgage. You don't have to get PMI. So sellers are very well educated now and they have realtors who are advising them and saying, this offer is a stronger offer, even though they're very similar or the same because they're putting more money down.
Yeah, but the reality is they're still getting cash. They're getting the 20% down and then the 80% mortgage.
Sure.
They're getting a payment either way, but
Yes.
for their perspective as the seller, there's less of a risk that they won't qualify or they'll have a problem down the line.
That is exactly what it is. They're getting the same amount of money, assuming it closes, but they think there's a better chance that it closes with someone who's putting a little more money. So that is, and I explain that to people when they say, I think maybe I'll just put down, 17 or 18% or 15%. I said, let's talk about can we put down 20% because that will help you when you're making an offer, it'll help you get an accepted offer because you're competing against cash, which is obviously hard to compete against. Those,
of course,
those are
cash is still king.
It is when you're making an offer on a house. Although sometimes the cash buyers will offer a little bit less because they know that sellers like cash offers. But the bigger the down payment, the more likely the seller is to accept the offer.
Refinancing. So how does that impact somebody? So they've been in a home. Let's give an example. They've been in their home for 5 years, but they have to refinance, even though they have a lower rate. Maybe they got into some financial difficulty, credit card debt, auto loans, college education for their kids. That happens. I'm sure you've seen that.
Yes.
So how do you help them to navigate that process?
So you usually, you just mentioned a bunch of life events, but usually you're refinancing to lower your rate.
Typically, right?
Or shorten your term or lengthen your term. If you have a 15-year and maybe you're struggling to make that payment, you want to stretch it out to 30 years to have a lower payment. That's not ideal, but that I do have people say, I got this 15-year mortgage and my payment's too high. Can you give me a 30-year mortgage? So life events will dictate if you need a refinance. But the best thing is if we can lower the rate and shorten the term, right? Can I lower your rate and go from you got a 30-year mortgage and you've had it for 5 years, there's 25 years left. Can we go to a 15-year and cut 10 years off and lower the rate? The other kind of refinance is a cash out refinance where you're taking some money out of your house based on the equity that you've accumulated just by either because you've made updates to the house or just because the housing market has gone up. So the refinance market has been quiet because there are a lot of people that have 2%, 3%, 4% mortgages.
They don't want to lose that.
And I feel pretty confident saying that if you have a 2-something% mortgage, the rate's never going to be low enough for you to refinance. So the only reason you'd refinance is to take some money out.
Or you're in some financial difficulty.
Yes.
Right.
So the refinance market has been quieter. Now there are people who have bought over the last 3 years that their rate's higher. So if there is a dip, then we'll see some more refinance activity. But most of the refinance activity now is because people are getting divorced or people need to pay for college or whatever, credit card debt.
Yeah, but now
how much of a difference? I'm sorry.
That's okay.
How much of a difference in the rates would you recommend somebody to refinance?
So here's another question that annoys people because I can't. It's a different. If you have an $80,000 mortgage, it has to be a lot. It has to be a percentage point or more. But if you have a $3 million mortgage, maybe half a point drop is significant. And there are other factors that we'll go over with a client. How long are you going to stay in the house? I think only another year.
Case by case, no matter what.
Right.
And you have to weigh it out.
Right. If you tell me you're going to stay in that house forever, then it may be more worthwhile if the difference is smaller because you're gonna have that lower payment for a long time.
Right.
If you're telling me you're going to move in a year or two, it's probably not going to be worth refinancing at all. So,
and the other piece that people need to recognize too is what you were saying. If they do a cash out from their mortgage, right? They go beyond the original mortgage. That's also not deductible if they are in fact itemizing.
The CPA in you is always watching, and that's why I tell people, and I say this: I'm not a CPA. Let's talk to your CPA about what we're doing and make sure it fits in. Especially if they're getting a gift. I have people in New Jersey. You talked about your sons, and I don't know if you're going to give them a gift, but often parents will give their kids a gift because they're having trouble coming up with a big down payment.
Right.
So there's tax treatment of that. So I often say, let's talk to your CPA and get them involved right away to make sure that this isn't going to impact something else that's in a bad way.
What about home equity lines of credit? So you knew I was going to ask that question eventually.
You are very well informed, and I assume you're asking me that because we were talking about cash out refinances. So you have a really low rate on your mortgage and you have a ton of equity in your house that you'd like to access. But if we give you a new first mortgage, you're going to have whatever the market rate is now. You're going to lose that really low mortgage you have. So to avoid that, you get a home equity line of credit, which is if you already have a mortgage, it's a second mortgage. So you're leaving that one alone. You're keeping that rate and you're getting a line of credit, which is exactly that. It's kind of like a checkbook that you use. Mm-hmm. Some people use it just to have
as an emergency fund.
Right. A lot of self-employed people that have inconsistent cash flow want a home equity line of credit, so they'll have it and maybe never or rarely use it. Or you're renovating your house, or it's college, or business opportunity, whatever it is. So that's a way to not touch that really low rate on your first mortgage, but still access the equity. Those rates are affected by the Fed, right? That is the prime rate. So home equity lines are typically tied to whatever the prime rate is. It may be prime, you see prime plus a half or prime minus a half. So whatever it is, but those rates are affected by what the Fed does more directly than a 30-year mortgage.
Are those rates standard though, or are they regional as well?
I think that even more granular, it's bank to bank. I'll see a bank that says we're prime, but if your credit score is 780, we're prime minus a half. Or if you have if you open a bank account and have the payment taken out, it's prime minus 1, or whatever it is. So that varies from certainly from bank to bank. Institution.
Okay, that makes sense. And what's the tax deductibility on home equity lines of credit?
I don't think they are at all.
No more.
No.
But it's important for me to bring that up because some people still think, remember, some years ago, it was $1.1 million of mortgage indebtedness that was deductible. And they removed the $100,000, and now they went from the $1 million to the $750,000. So but again, those shouldn't be the deciding factors.
Right. And I would give my answer that I don't think it's deductible anymore, but talk to your CPA is what I would say.
Anyway, all right. So we're coming to the close. So what are in summary, what are the three main factors that or brief points that you can let our audience know, and be sure, audience, to like and subscribe to our podcast. But Aaron, tell us what those 3 main points are when it comes to mortgages in general.
Okay. 1, talk to your lender early on in the process. If you think you're going to buy a house in a year or 6 months, talk to your bank or your mortgage broker or mortgage bank, whoever it is, pretty early and say, let's talk about what I can afford. Do I need to save more? Whatever, let's strategize, especially if you're self-employed. 2, get all your financial professionals involved. Talk to your CPA, talk to your financial planner, your attorney. And if you don't have them, it's time to make, if you're going to buy a house, you should have I think you should have a CPA. I know that TurboTax and whatever else has changed things, but I still like to have a person advising as to tax matters. So talk to a lot of different professionals and explain where you want to go, and we can talk about how we're going to get there. The biggest thing, I think, is buy a house when you're ready to buy a house, not when you think it's a good time economically, right? I mean, the rates go up and down, and housing prices go up and down, and when you have a job that you're comfortable in, your income comfortable, and your assets, and you have some savings, and you're ready to buy a house, then buy a house. You're not going to time it. You're not going to buy a house when the rates are at their lowest point or at the prices are at their lowest point, except by luck. It's virtually impossible to time. It's like trying to time the stock market. So I think that's
those are the big factors.
A big takeaway. And
very good. Very good. Thank you very much, Aaron. Jim, do you have any other final thoughts?
No, I appreciate you coming, and maybe we can have you back out.
It was a pleasure to be here. Thank you very much for
everyone. Aaron Galileo of PPAC Bank, correct?
PPAC Private Bank and Trust.
It's a mouthful.
Yes.
But better you say it than me.
Thanks again for having me.
You're very welcome.
Thank you for joining us on this episode of Enlightened Wealth Strategies. We hope you found today's discussion insightful and inspiring.
If you enjoyed this episode, don't forget to follow and subscribe to our podcast. You can find us on YouTube, Apple Podcast, Spotify, or your favorite podcast platform to stay updated on new episodes.
Your financial journey doesn't end here. Connect with us online for even more resources and exclusive content.
Until next time, remember, financial enlightenment is just an enlightened wealth strategy away. Investment advice is offered through Bell Point Asset Management, LLC, 500 Demont Ranch, Parkway Building 700, Unit 700, Reno, Nevada, 89521. Additional information about Bell Point Asset Management is available on the SEC's website at www.advisorinfo.sec.gov. It is important to read our disclosures available at this link, www.bellpointasset.com/disclosures. The information provided in this presentation is educational and limited to the dissemination of general information. This material is not intended to be a recommendation of any kind, investment, tax, or accounting advice. Does not constitute a solicitation to buy, sell, or hold a security or an investment strategy. Engage in any financial transaction and is not provided in a fiduciary capacity. The information provided does not take into account the specific objectives or circumstances of any particular investor or suggest any specific course of action. Investment decisions should be made based on investor's objectives and circumstances and in consultation with his or her financial professionals. While the advisor uses reasonable efforts to obtain information from sources believed to be reliable, the advisor makes no representation that the information or opinions contained in this material are accurate, reliable, or complete. All information and opinions contained in this material are subject to change without notice. The views and opinions expressed are for informational and educational purposes only as of the date of the production or writing and may change without notice at any time based on numerous factors such as market or other conditions, legal and regulatory developments, additional risks and uncertainties, and may not come to pass. This material may contain forward-looking information that is not purely historical in nature. Securities offered through Fortune Financial Services, Inc., member FINRA and SIPC, Bell Point Asset Management, LLC, and Fortune Financial Services, Inc. are not affiliated. Past performance is no guarantee of future results. Investing involves risks. Principal losses possible.